Hello and welcome to our channel, Stockwisely. In this video, we'll be discussing some of the common mistakes that beginner investors make when investing in the stock market. We'll offer practical advice on how to avoid these pitfalls and invest wisely. So, let's get started. Mistake 1. Failing to diversify. One of the biggest mistakes that beginner investors make is failing to diversify their portfolio. This means putting all of your money into one stock, sector or industry. By doing this, you're not only risking all of your money, but you're also missing out on potential gains from other opportunities. Instead, you should aim to have a well-diversified portfolio, which means investing in a variety of stocks, bonds, and other assets. This helps to spread out the risk and can help protect your portfolio from market volatility. How to diversify portfolio? Diversifying a portfolio means investing in a variety of assets in order to spread out risk and minimize potential losses. By doing so, you can reduce the impact of any one investment on your overall portfolio. Here are some ways to diversify a portfolio. Invest in different asset classes. One way to diversify your portfolio is to invest in different asset classes, such as stocks, bonds, real estate, and commodities. Each asset class has its own unique characteristics, and by investing in a variety of them, you can spread out risk and potentially maximize returns. For example, if the stock market is performing poorly, your bond investments may perform well and help offset losses. Invest in different sectors. Another way to diversify your portfolio is to invest in different sectors of the economy. For example, you may invest in the technology, healthcare, financial, and energy sectors. Each sector has its own unique risk and return profile, and by investing in a variety of them, you can reduce the impact of any one sector on your portfolio. Invest in different geographies. Investing in different geographic regions can also help diversify your portfolio. For example, you may invest in both domestic and international stocks, bonds, and other assets. This can help spread out risk and potentially increase returns. Here are some examples of how to diversify a portfolio. An investor may choose to invest in a mix of large cap and small cap stocks, as well as international stocks and bonds, in order to diversify across asset classes and geographies. A retiree may choose to invest in a mix of stocks and bonds in order to diversify across asset classes, and may also choose to invest in different sectors of the economy, such as healthcare and utilities, in order to reduce risk. A young investor with a high risk tolerance may choose to invest in a mix of stocks, bonds, and real estate, and may also invest in emerging market stocks in order to diversify across asset classes and geographies. Remember, diversification does not guarantee a profit or protect against losses, but it can help minimize the impact of any one investment on your overall portfolio. Be sure to consult with a financial advisor to determine the best diversification strategy for your individual needs and goals. Mistake 2. Making emotional decisions. Another common mistake that investors make is making emotional decisions based on short-term market movements. For example, if a stock price suddenly drops, some investors panic and sell their shares immediately. However, this can often result in selling at a loss and missing out on potential gains in the future. Instead, it's important to have a long-term investment strategy and stick to it, even in times of market volatility. You should also avoid making decisions based on fear or greed, and instead rely on research and analysis. How to control emotions. Controlling emotions is an important skill for any investor in the stock market. Emotions can cloud judgment and lead to impulsive decisions that may not be in the investor's best interest. Here are some ways to control emotions. Stick to a plan. One way to control emotions is to have a well-defined investment plan and stick to it. This plan should take into account your risk tolerance, investment goals, and time horizon. By having a plan in place, you can avoid making impulsive decisions based on short-term market movements. Take a long-term view. It's important to take a long-term view when investing in the stock market. This means focusing on the fundamentals of the companies you are investing in, rather than short-term market movements. By taking a long-term view, you can avoid getting caught up in the emotions of the moment and make more rational investment decisions. Manage risk. Another way to control emotions is to manage risk. This means diversifying your portfolio across different asset classes, sectors, and geographies. By diversifying, you can reduce the impact of any one investment on your overall portfolio, which can help minimize losses and reduce the temptation to make impulsive decisions. Here are some examples of how to control emotions. An investor may have a well-diversified portfolio with a mix of stocks, bonds, and other assets. If the stock market experiences a sudden drop, the investor may be tempted to sell off their stocks in a panic. However, by having a diversified portfolio, the investor can weather the short-term volatility and avoid making an impulsive decision that could hurt their long-term returns. A new investor may be tempted to jump into a hot stock that everyone is talking about, even though it may not be a good fit for their investment plan. However, by sticking to their plan and focusing on the fundamentals of the companies they are investing in, the investor can avoid making an impulsive decision that may not be in their best interest. A seasoned investor may be tempted to chase after the latest investment trend, even though it may be high risk and not a good fit for their portfolio. However, by managing risk and sticking to their investment plan, the investor can avoid making an impulsive decision that could hurt their returns. By controlling emotions and making rational investment decisions, investors can potentially make more money in the stock market. By focusing on the long term and managing risk, investors can avoid short-term volatility and make sound investment decisions that lead to long-term gains. Mistake 3. Not doing enough research. A third mistake that beginner investors make is not doing enough research before making an investment decision. This can include failing to research a company's financials, management team, or industry trends. By not doing your due diligence, you're putting your money at risk and may miss out on important information that could impact your investment. Instead, it's important to do thorough research before making any investment decision. This could include reading financial reports, following industry news, and consulting with financial advisors or other experts. Research is a critical component of successful investing in the stock market. Here are some ways to conduct research. Identify your goals. The first step in conducting research is to identify your investment goals. This could include finding stocks that match your risk tolerance, growth objectives, or income requirements. By understanding your goals, you can tailor your research to find stocks that align with them. Use reliable sources. It's important to use reliable sources when conducting research. This could include financial news websites, analyst reports, company filings, and other reputable sources of information. Be wary of sources that are biased or unreliable, as they could lead to poor investment decisions. Analyze company fundamentals. One of the most important aspects of research is analyzing a company's fundamentals. This could include its financial statements, industry outlook, management team, and competitive position. By analyzing these factors, you can assess a company's growth potential and its ability to generate returns for investors. Consider the macroeconomic environment. The macroeconomic environment can have a significant impact on the stock market. It's important to consider factors such as interest rates, inflation, and geopolitical risks when conducting research. By understanding these factors, you can better assess the risks and opportunities of investing in a particular stock. Use technical analysis. Technical analysis is a method of analyzing stock prices and volumes to identify patterns and trends. This can help investors make more informed decisions about when to buy or sell a stock. Technical analysis can include charting, trend analysis, and other tools to identify patterns in the market. Here are some examples of how to conduct research. An investor may be interested in buying shares of a particular company. They could start by reading the company's annual report and financial statements to gain a better understanding of its financial position. They could also research the company's industry outlook and competitive position to assess its growth potential. A new investor may be interested in investing in a particular sector, such as technology or healthcare. They could start by reading financial news websites and analyst reports to gain a better understanding of the industry. They could also research individual companies within the sector to identify those with strong fundamentals and growth potential. A seasoned investor may be interested in identifying trends in the market. They could use technical analysis tools such as charting and trend analysis to identify patterns and trends in the stock market. By using these tools, the investor could potentially make more informed decisions about when to buy or sell stocks. Conducting research is an important part of investing in the stock market. By identifying your goals, using reliable sources, analyzing company fundamentals, considering the macroeconomic environment, and using technical analysis, you can make more informed investment decisions that can potentially lead to higher returns. So there you have it, 3 of the most common mistakes that beginner investors make when investing in the stock market. By avoiding these pitfalls, you can increase your chances of making wise investment decisions and achieving your financial goals. Remember to diversify your portfolio, make decisions based on research and analysis, and have a long-term investment strategy. Thanks for watching, and be sure to subscribe to our channel for more stock market tips and advice.